Good morning, hunters. Welcome back to the Daily Hunt for Multibaggers. I'm Ethan.
And I'm Rook. Today is Thursday, April 30th, 2026, and we're breaking down yesterday's market buzz, April 29th, that our AI has flagged.
We saw a significant surge in activity yesterday, with a high volume of discussions across many different stocks. It was quite the mixed bag, you know? A lot of optimism for some of the big tech names, but also a fair bit of caution and skepticism, especially around those more speculative plays.
Absolutely. Our AI insights show a clear split between promising growth narratives and some pretty high-risk situations that demand our attention. Let's dig into it.
All right, first up, let's talk about Microsoft, MSFT. Our AI picked up a ton of discussion around them. Users are generally optimistic, especially long-term, citing their strong Q1, incredible Azure and AI growth. The stock's current price being below its 52-week high, for many is seen as a solid buying opportunity. Our AI insights suggest a buy. This is an upgrade from its previous cautious buy rating.
Well, Ethan, while the fundamentals are strong and those earnings were indeed good, we did see some user sentiment reflecting a sell the news mentality. There's an undercurrent of skepticism about short-term reactions, and its PE ratio, while reasonable, demands consistent high performance. It's always about balancing potential with current market sentiment. But yes, the strong KPIs do support the buy call.
Next, let's pivot to Meta Platforms, Meta. Despite some really strong Q1 results, a significant revenue jump, and even some insider buying, the community sentiment, even for a bet on Meta post, quickly turned negative due to major capital expenditure concerns.
You got it, Ethan. The market got rattled by their massive planned AI and AR/VR spending spree. Users were calling it suicidal capital expenditure. When your stock slides despite beating earnings, it tells you the market is really questioning the return on those huge investments. The PE ratio starts looking a lot less attractive when you're burning cash on uncertain ventures. It remains a stay away for us, mirroring its previous rating.
Moving on to Nokia. The buzz around Nokia is remarkably bullish right now. Users are actually seeing significant gains, largely attributing it to the company's transition into the AI sector, new AI partnerships, and even €1 billion in AI orders. Analysts like Kramer are also turning bullish, which is a good sign.
It is, but let's temper that enthusiasm with some KPIs. That PE ratio is extremely high at nearly 78, indicating a lot of future growth is already priced in. Current revenue growth and net profit margins are still relatively low, and their debt-to-equity ratio is a bit concerning. While the AI news is certainly exciting, it's a speculative play based heavily on future potential. We're classifying it as a cautious buy, a downgrade from its previous buy due to that high valuation risk.
Now Tesla, TSLA. The community isn't feeling optimistic about a short-term run, you know? While there's always that it doesn't trade on fundamentals narrative and some minor insider buying, the overall tone is quite bearish.
And for good reason, Ethan. Its PE ratio is astronomical at over 345. The PEG ratio is over 5, and its debt to equity is incredibly high. Users are talking about horrible earnings and selling at a loss. The stock is significantly below its 52-week high, and that falling Starlink revenue per user could dampen the SpaceX IPO catalyst some hope for. This remains a clear stay away, consistent with its past warnings.
Next up is SoFi Technologies, SoFi. Here's a mixed signal. They reported strong overall revenue growth and met EPS estimates with substantial insider buying. Some users are even seeing a bargain here.
But Ethan, the critical point is the 27% fall in their tech platform revenue. SoFi positions itself as a tech bank, but that core tech component is struggling. The market reacted harshly with a 9% pre-market drop. Users are saying it should be valued like a traditional bank, and its PE of 34.5 is far too high for that. It's also trading at half its 52-week high, indicating strong negative momentum. Given the tech platform concerns and high valuation, it's a stay away for us, a downgrade from its previous cautious buy. All right, let's talk about AST SpaceMobile, ASTS. This one is generating a lot of buzz. Many users are cautiously bullish, seeing it as a long-term disruptor for global 5G connectivity. They're pointing to major partnerships with Verizon and AT&T and recent FCC approval. Despite some short-term pain, many are buying the dip with strong conviction. I hear the optimism, Ethan, but the KPIs paint a very different picture. ASTS is deeply unprofitable, with a net profit margin of 0 and negative EPS. Its beta is extremely high at 2.8, meaning it's incredibly volatile. And let's not forget the recent failed Blue Origin launch. That's a huge operational risk. While the vision is grand, the financial and execution risks are substantial right now. We're classifying it as stay away, continuing its previous speculative gamble and stay away ratings. For Amazon, AMZN, it's looking strong. We saw a positive market reaction to their recent earnings, with news highlighting a huge AWS deal with Meta and impressive logistics achievements, like delivering 1 billion items same day or overnight. Insider buying is also a very bullish signal. Our AI sees it as a buy. That's an upgrade from its previous cautious buy rating. It's true, the growth and efficiency are undeniable. However, the stock is trading very close to its 52-week high, and that PE of 31.46 demands consistent high performance. While the fundamentals are solid and the inside confidence is good, investors need to be aware that much of this positive news is already reflected in the price. And then we have Alphabet, Google. This is a classic long-term winner. Users are celebrating multi-decade returns with stories of 1,000% gains. Their Q1 beat was strong, Google Cloud is booming, and they're pouring aggressive capital expenditure into AI and cloud infrastructure, even planning to sell their own TPU chips. Add in massive insider buying, and it's a very bullish picture. Well, Ethan, it's hard to poke holes in this one, honestly. The KPIs are stellar: 18% revenue growth, a 32% net profit margin, and those strong inside purchases. While its PE of 26.53 is fair, for a company of its size and proven track record, it still signals high expectations. The challenge here is simply, how much higher can it go after such a consistent run? But all signs point to a buy here, maintaining its previous rating. Last up is Rocket Lab, RKLB. The community is strongly bullish, pushing back on the idea of launch commoditization and highlighting RKLB's competitive advantages and strong execution, particularly with the Meta partnership. Many see current dips as prime buying opportunities. I know the community is excited, Ethan, but the fundamentals are shouting caution. Rocket Lab is deeply unprofitable, with negative net profit margins and EPS. Its price-to-book ratio is very high, suggesting significant future growth is already priced in. And the biggest red flag, insiders have been massive net sellers, reducing their holdings by over 73%.
And that wraps up another episode of the Daily Hunt for Multibaggers.
Remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making any investment decisions. We are not responsible for any losses incurred.
The market is a wild place, and knowledge is your best asset. Thanks for joining us, and happy hunting.
We'll catch you next time.